On today's episode of the AI Investor Podcast from 24/7 Wall Street, we explain why some of our recent buys are soaring, dive into Elon Musk's latest bet, and share a few more stocks that we're doubling down on. All of that is next. Welcome back, everyone. I am David Hanson, and I'm joined by Eric Bleeker. Eric, I've humbly asked our listeners to leave a rating, give us a review. After one of our stocks is up almost 50% in a day, if that doesn't earn us a rating, I don't know what to tell you. I guess we'll just never get a rating. So please, if you like the show, please go give us a rating.
We'll even send you a banana, not a $6.2 million banana, but a banana.
But yeah, it's been again, I always make the comment, we record this podcast every 2 weeks. Every 2 weeks, it seems like there's crazy developments in this space. And that's certainly been true of the last couple of weeks. We've had some companies in the portfolio that have just had enormous moves from their stock, also very impressive earnings and guidance that has been given by some of these companies. So that's what I want to start with, because anyone who's been listening to the show, one of the things we try to do is bring actionable ideas and stock ideas, and we manage it in a real money portfolio that you've been walking everyone through. So let's start with some of those companies that have had these really big moves and what it means for them, but also kind of a new narrative that might be emerging for some of these companies. So where do you want to start?
Yeah, David, you really captured it with the new narrative. We said in that first episode of this show, imagine what it would have been like when the internet started. If you could have followed along for the whole ride of it, and the internet had ups where people made a lot of money, it had crashed where people lost a lot of money. But at the end of the day, if you had started with the internet, you actually had the keys for the next 25 years of investing, because largely what the internet changed, it built wealth for every major story, whether it was, Amazon taking the internet to retail, or Netflix with a new paradigm in streaming, or something direct with the internet like Google, or new industries like social media. And we believe the same will be true of artificial intelligence over time. And this week, I could just really feel in my bones watching everything that's happening is some of the inflection points that's taking off, and something we've been talking about, which is this next wave beyond kind of just NVIDIA. 95% of people, if you were at Thanksgiving and stocks came up, it's probably something like NVIDIA or Bitcoin.
Right.
But we're about to start seeing a next wave of story stocks and kind of big winners developing. And you really saw some incredible stories developing across the past 2 weeks. So let's talk about Marvell. This is a stock we had first added to the portfolio on the November 8th episode. I have been publishing a lot about Marvell. If you're following me on social media, I was tweeting about the day before earnings saying to watch this stock because they've got a big ramp coming from Amazon. I published a big article diving into a lot more detail on 24/7 Wall Street, saying that it is the number one AI stock to buy. This was all before earnings. They report earnings. They're up 24% the next day, which is a huge jump for a company of this size. And The background on Marvell is they do a lot of custom work on chips. And the big customer they have right now is Amazon. And you could really, what I kept highlighting, I put in that article I wrote, we'd send it to 24/7 email subscribers. I tweeted out, was there was a PR campaign about how Amazon is going all in on its custom chips. The WSJ had an article that was titled, Amazon's building a supercomputer with hundreds of thousands of Trainium chips, which again, David, we've talked about the top of the line being 100,000 chips now, and the next evolution being hundreds of thousands. And this is Amazon getting publicity about, their initiatives to build their homegrown supercomputer that is that next generation. Bloomberg titled their article, Amazon's moonshot plan to rival NVIDIA chips. So the signs were all there headed into earnings. And what we saw was from Marvell, a compelling enough guidance for people to say, okay, they're on this inflection point. But a few things from this as well. We've talked about there's the chips, and then there's the networking side. And a big part of this story with Marvell was they have had a partnership designing the AI chips for Amazon. The day before earnings, they announced another agreement covering things like custom DSPs, active electronic cable DSPs, PCIe retimers. This might sound a little bit like an alphabet soup to people, but these are all the components that are seeing, the amount of sales, the amount of content as data centers get a complete new architecture for the AI age. Their sales are just absolutely exploding. And Marvell now not only has a contract for the chips for Amazon, they have a contract for all the other interconnects and networking across the data center. So this is really important. And again, like you were saying, David, it's kind of opening up this next narrative, right? So I think when we look at Marvell, we're looking ahead here. They still have a deal with Microsoft that is yet to ramp. There are a lot of different hyperscalers and large, cloud computing enterprises. All these companies, they're much more than one larger customer. So they still have a very large ramp ahead that they said with Microsoft might even be larger than Amazon. So, Marvell after these earnings, it's a $100 billion company. That's still with a top line less than 10%. That's an expensive company. So the question is, are you going to take this pop and run? And I would say we will continue to hold Marvell because Amazon's just the first of several catalysts. Beyond custom chips at Amazon, you have the Microsoft ramp. We have a telecom cycle firing back up, which helps them. We have other partnerships with hyperscalers ramping. So the CEO of Marvell, Matthew Murphy, he was asked in the conference call, he's been cited as a candidate to replace Intel's boss, who's departing. We'll talk about that a little more later. And he said, why would I leave? This is the single largest TAM, total addressable market opportunity of my life. So David, I think starting off with Marvell, congratulations to any listeners who bought this. Congratulations with anyone who's reading the articles, the emails we sent. But this is the key point we're talking about here, an inflection point where all of these next generation data centers we've been talking about for months, that's going to take off. We are starting to see the results in some of these companies. And, we'll cover more here, but it is not just Marvell.
Yeah, before we move on to another company that is certainly benefiting in a much, much big way, I want to ask about Marvell again. It's up around 25% in the last month, which is great for anyone who bought it. Anyone who didn't buy it, it sounds like you still feel okay holding it and have expectations for further growth here. Would you adjust kind of the position size based on that 25% run, or is it the same amount that you would have done 25% ago? Do you still feel okay, or should people be like, it's a little more expensive now? How do you feel about that, or is that not really into the equation yet?
Well, I've got a spoiler. After we talk about this next company, I do have a specific recommendation on a specific play related to Marvell's valuation today. But I would not adjust Marvell. I will not be. I hold in the AI portfolio, and I also hold it in personal holdings. I'm doing zero adjustments after these earnings. So I like the story throughout 2025, and I like their placement in this trend.
Okay, well, let's move on to the other company, and that's Credo, the company that was up almost 50%. Did it touch 50% on the day?
It did touch, 50%.
Just an absolutely monster move for a company that we had added to the portfolio prior to Marvell. So it's probably been about 2 months since we added that stock to the portfolio. And obviously just even in smaller companies, not tiny, but smaller companies like Credo, you don't often see 50% moves. So is it the same story? That is a company, when you first introduced it, you gave the analogy of the F1 racing of, hey, you got to have a great engine. And in the world of AI, that's kind of the NVIDIA chips, but you need to have a great suspension and everything around it. And Credo is one of those plays supporting the new age data center. Is that really just what was happening here? And they hit that inflection point that you talked about 2 months ago?
Yeah, I'm glad you brought the F1. I forgot that. Now I can put it back in my kind of bag of phrases for AI. But I think that's very much what's happening, David. You look at their guide for next quarter. Wall Street was expecting 86 million in sales. They guide to 115 to 125. David, you've been investing for a long time. When you blow out a guide like that, it forces what we call a re-rate. All future expectations for your growth have to go up. And that's what is happening right now with Credo. So we recommended Credo. We talked about on the show on September 27th. And as we filmed this, since that date, September 27th, it's up about 170% since filming. We've talked about being a little bit more high risk, high reward, but the big opportunity around them is, again, this connectivity in AI, and their main market is something called active electronic cables. They're involved in many areas. They're all growing, but that's where they're seeing the growth. I've got a couple quotes from the CEO here. He said, really, in the last 90 days, we've seen a couple of projects come together in an even stronger forecast than we expected. Because again, what Wall Street's asking is, hey, why haven't we gotten a signal that we were going to see this big of a jump? You kind of made us look stupid, right? Mm-hmm. And now we're all having to catch up. And he's saying this is really coming together in the past 90 days, which again, we're looking for this inflection point. When I looked at Lumentum's last earnings, and we had recommended them in the past as part of kind of our optical basket. Their quote was, "I think we're counting on meaningful revenue in 2025, but really setting us up for significant growth in 2026 on optical switching inside the data center." So it's been that there's this ramp that everyone's talking about, but when is it coming? And you could look at Marvell and say, well, they had a big ramp, but sure seems like that might be kind of a one-off thing with Amazon ramping. The thing about Credo is they have 7 customers that represent more than 5% of their business. They're basically in all of the major hyperscalers. They're in all the major data center companies, which means they have significant order flow coming in across the board. And David, it is, you ask why, and it is because these cables that they're selling, they're all about reducing downtime because, as their CEO said, even a momentary blip can cause a training run to go offline for 30 plus minutes. You want maximum uptime, and they're also extremely power efficient. So what we're looking for is we know there's going to be all this money pouring into all these data centers being created. We know there's going to be GPUs or custom chips. We know it's going to be either NVIDIA or a company like Marvell and Broadcom. Then we know there's going to be we know that there's going to be networking, I should say, attached to that. And the question is, in all these different areas that we're talking about, how much revenue per GPU will these companies get? And what Credo said is effectively, they were thinking that they would have basically 1/2 of one of these AECs, these electronic cables per GPU, but now they're thinking it might be 1 or higher. So all of a sudden, that's driving their addressable market up significantly. And I might note Marvell on their conference call, they kept calling out the AEC market as well. So, what we're really looking at right now, we're looking at this explosion around networking spend. And then we're trying to understand, we know the GPUs are coming in, but what are the categories that are going to be seeing the most significant upside in these next generation data centers? We saw the potential with Credo, what happens when more of your content gets in than investors expect. But this is why this is beautiful, David. This is what you dream of. This is a stock picker's market, right? This isn't, I'm just buying Apple and sitting on my hands, and Apple may work. If you actually know the details and you understand this market, you can really see a significant amount of gains. And it requires a lot of knowledge, a lot of digging into the details. It requires understanding the high-level opportunity. But if you can understand this, there are companies that are going to see significant gains in revenue to come. So, I talked about kind of filling out the optical basket with the companies that we've talked about before, Coherent, Lumentum, we add Fabrinet to that. And then, we've got other plays in this, big companies like Marvell and Broadcom. And then we had Ciena for kind of the data center interconnects, and Credo as well for another play of growing content, this next generation networking. I don't think we're close to done at all, because even looking at the earnings from Credo, number one, it's showing me that a lot of these new technologies that are really built for this next generation architecture, they're seeing Credo itself is seeing a lot more, but it's also, continuing to emphasize the value of going in and understanding this next generation architecture, because Credo is not going to be the last company seeing 50% a day across this next year. If we are really seeing a takeoff across these data centers, seeing spend jump by a significant amount, we're going to see a lot more companies. So this continues to be an area that I'm tremendously fascinated in. And I do have a recommendation. So, David, if we want to cut off Credo, I'll talk about the company I think investors should be adding to their portfolios immediately.
Yeah, I definitely want to get to the actionable trade and ads you're making. I do want to emphasize, and it's the point we've made before, when you're talking about all these plays in this new age of networking and data centers, there's surprises to the upside, like you just said, in terms of something down to the nitty gritty of Credo saying, hey, we're actually going to have maybe 1 or 1.5 versus the half we thought. So that surprises the upside. There can also be surprises to the downside, where a company might think they might be involved, and then 18 months later, it's like, oh, we actually overestimate. So I just want to stress that's why we have this portfolio approach, because you might be wrong on some of these, and it might not be, might not look wrong today, but things happen, things evolve, different, ways of the market evolving. There can be negative downsides too. I don't, in all this excitement of the portfolio doing well, I want to stay focused on the fact that you need to have a portfolio of these companies, because you could also have a down 50% day if things don't work
it's
out.
worth mentioning, right? I've made the point in the past, when you see explosive growth in a market like we're seeing with this kind of data center, AI centric networking, the company that's in leadership positions going to see great growth at the beginning, in part because everything's about they want more data centers. They don't have time for unproven technology. You go with the existing leader, you go with the incumbent. Now, as this matures, though, there is, potentially a lot of shift that happens. Like we see right now, suppliers to NVIDIA, if you're getting booted out of their systems, or there's any indication that you are losing content inside, it's kind of like the old suppliers to an Apple iPhone. There's a company, Monolithic Power Systems, that a lot of people were buying because it had a lot of sales attached to Blackwell. And now there's been some reports that they're kind of getting removed from this, and the stock's dramatically down. Stocks within our portfolio have exposure to Blackwell, like Fabrinet, for example. So there are some times I was talking about what's kind of the attach rate, how much of this AEC market are you seeing per GPU sold? There are risks that, for example, optics, their attach rate to a GPU could go down as well. Now, they could also increase. There are reasons that they could increase. But yes, to your point, this is why we're building the portfolio approach. And we would like it to be tilted towards things that we believe are, future proof as much as possible. But you're never going to be right 100% of the time. You can't get too high about being up on Credo 170%, because you do want some weightings on things that are up less, right? So I think it's a fantastic point to add, and why anyone, if you're following us, please don't buy one stock. We'll constantly talk about the portfolio. We put a list of them on 24/7, wallstreet.com. Please continue to invest across the portfolio.
Okay, well, let's not tease this last one too long. Let's just spend just 1 or 2 minutes on the company that you are going to add based on what's happened the last couple of weeks.
Yeah, and I want to add Broadcom. I'm mad as we're filming this. Let me pull it up right now. I think it's up 6% today. 5.7%. I've been saving it to want to invest in, because it is very much a peer to Marvell. It also does custom, accelerators. It has a huge networking business. It's a company. NVIDIA is the most levered to AI company in the world. The second, though, is probably Broadcom, because they are, as we've talked about, if NVIDIA is the Apple with kind of everything in an integrated solution, Broadcom very much is the alternative, where they let data centers and hyperscalers kind of build out networking that's not connected to NVIDIA. They've got custom chips. So I've been watching as Marvell has been rising on this custom chip opportunity and the growth in a lot of spending categories and networking, and wondering why Broadcom is trailing. I think a part of it, in their last earnings, they didn't take projections for AI revenue as much in the next year. But again, you do the read through from other companies, and a lot of these companies are talking about a lot of demand starting to be unlocked in the past 90 days as a lot of these conceptual data centers move closer towards actual build outs. Broadcom, I believe they report on December 13th. I'm ready to buy shares before then, continue expanding the position. So we have at 15,000. I'll add 20,000. That takes up to 35,000, makes our number one position. Broadcom's an $800 billion company. I do not expect it to move 23, 25% after earnings. You never know, but I don't expect that. But it is just a core holding that anyone can take it. You can buy an outsized position, and you can be very comfortable as this with a stock in many of the highest growth opportunities of AI. So we're just going to continue to take that up. And the opportunity I'm seeing to take this action today is, again, some of that relative valuation against Marvell. I think the market's just kind of discounting it right now, and I'm going to use that as an opportunity.
Okay, so there's the add to Broadcom, ticker AVGO. I want to move on to a couple more news items. You mentioned Intel and CEO leaving there. I want to get to that in just a second, but I also wanted, as we're recording this on Friday, news of XAI, Elon Musk's, yet another one of Elon's ventures, reports that they're kind of upping the stakes on a supercomputer of 1 million GPUs, which we talk about 100,000 being a lot and now 1 million being thrown out there. So what was your takeaway from this headline coming across today?
Yeah, and this is from Financial Times. I've got the headline here. It's Elon Musk plans to expand Colossus AI supercomputer tenfold. As we've talked about in the past, Elon Musk XAI company, they built a cluster with 100,000 GPUs. What was astounding about was it took 122 days from beginning of planning to completion, took 19 days from the time they got the racks on the floor for it to begin training models. NVIDIA CEO said he was amazed by it. Will have taken others years. Now, the biggest, if you're looking very granularly, just at this specific build, if Elon Musk is going to deliver, and Elon Musk says a lot of things that are shoot for the moon, land somewhere in between. But if he were to deliver XAI to increase their time to market, I've talked about NVIDIA having kind of the integrated systems approach. They used NVIDIA's GPUs, but they also used NVIDIA's networking. It would be a tremendous boon to them. If we're looking at something around $30,000 per GPU in cost, just this one supercomputer, this one cluster, would give about $30 billion to NVIDIA, which for reference is equivalent to basically an entire quarter of their data center revenue. Is it possible? Well, XAI, they just raised another $6 billion. They've raised, I believe, $12 billion in recent months. They're now valued at $40 billion. So I think they're going to continue spending. I don't know if they'll hit that level. But David, the bottom line here is this is just, we talked last week about scaling laws, and there are concerns. And there was some news this week of OpenAI releasing another model that a lot of people were disappointed in. But OpenAI just did a fundraising round at $157 billion with $6 billion more to them. XAI just did another $6 billion, talking about a million GPU cluster. And Anthropic, they just raised $4 billion from Amazon, contingent on them using these homegrown chips. So, well, we are looking ahead and monitoring this scaling law situation. The fact of the matter is, all of the funding to buy more chips is as hot as ever. And this is just one more data point in that.
All right, let's move on from something quite exciting, quite bold, to something that's not been quite as bold. We've talked a little bit about Intel, and now there's the news is broken. Their CEO will be leaving. So I just wanted to get your take. What does this mean for the company? So that's one question I had for you. Is just, it had been a rough run for Intel. What does this mean for them going forward? And my other question is, does anyone win because of this path that Intel is going down? So Intel has been I don't want to call it a loser. It's struggled. Where do you see that company going? And then does anyone win from where the company is right now, or continue to build an advantage versus Intel in a way that you see?
Just taking more shots at Intel, David. I think the reality is they announced this as a retirement. It was not a retirement. Pat Gelsinger, the previous CEO, he was fired. They backdated it to December 1st. They have no replacement lined up. So it's a firing. It's a very curious firing because they're on the edge of a really make or break kind of technology advance. They're moving towards their next process for creating chips, which is called 18A. It is tremendously ambitious. They've essentially more or less skipped generations to get towards what they would see as a technology leadership position. So it's a very weird time. Now, why is this likely happening right now? Well, there's the CHIPS Act, which has a lot of attention, is giving funding to semiconductor companies. Intel's getting funding. But if you look at the details of that funding, if the foundry that's getting funding is not essentially 50.1% owned by Intel, the US government can claw back its funding. So they essentially had to decide right now, if they're taking this funding, are we going to stay together as a company, or do we want the optionality to split our manufacturing and our design? And it looks like Gelsinger's always said, if you want to split these two up, I'm not the person for the job. It looks like that's what the board said. They said, we think we want to keep the optionality to do that. The foundry for Intel, even though they're pushing towards this, very cutting edge technology, still burning about $20 billion a year. So the idea is if you brought in someone who's much more a private equity type person, Intel's design business might be worth more than the current market capitalization of the company because the foundry is burning so much. They also have stakes in Altera, which is pretty valuable. They have a huge stake in Mobileye, which is self-driving. So you could sum of parts of the company. Its design for its CPUs, you'd have companies like Broadcom, like Qualcomm that would have an interest in that. You could try and get funding for the foundry, spin that off. It's kind of make or break right now, because if you don't do this right now, there's a good chance the foundry just swamps everything and the company goes bankrupt. So, David, that's the why. Do I think it's a smart idea? It's tough because they need to do something dramatic, but they need to do some dramatic years ago. So, it's truly as much as Intel is a company that still has the amount of employees they have. I believe they have more than 100,000. It is make or break. Even if you're looking, I saw, some blogs, Fabricate Knowledge had some sum of parts analysis. There might be some upside for Intel. It's not a huge amount of upside on the sum of parts. So this isn't something I would. There is some chance if you buy it today, you are getting a positive return, but it's not worth the risk to me, especially when there's so many companies seeing positive business catalysts everywhere. I wish Intel the best, but my most likely kind of outcome from this is I do believe you'll have some situation where an effective bailout from the US government for its foundry business, whether that's subsidizing companies using Intel's foundry, direct cash injections. I'm not sure on that, but once you lose leadership, the US used to have a leading lithography company competing with ASML. It went bankrupt, and once you've lost it, you can almost never get back. China's trying to spin up competitors in a lot of these areas, but you're in a 20-year deficit. So I think the US is aware how competitive it is, and I would guess there will be government intervention as a most likely scenario.
So maybe a winner. We've talked a lot about Broadcom and its history of being acquisitive and gobbling up tons of different companies. So maybe a winner there is those companies like Broadcom being able to come in and maybe add on to their business. Is that?
I think so. Yeah. An acquisitive company, you might be able to get a good value here. And your downside is that you just simply pass on it. But I would say Broadcom, there's been smoke around Qualcomm. We'll see. But one of these companies will probably get what they consider a pretty good deal on this. So one more piece of news that I wanted to hit before we jump into a couple more companies in the portfolio is Salesforce reported earnings. Wasn't a knock the cover off the ball type earnings, but this is a large company. It was up, I think, around 10% on earnings. So any new takeaways? This is a company we've talked a little bit about, especially with regard to AI agents, is something that they might be well positioned with their large customer base to be able to introduce new technologies, new software. So did you have any takeaways from the Salesforce call? Yeah, I thought the earnings were extremely middling. And then you look at its results the next day and the stock's skyrocketing. And I couldn't make heads nor tails of it until you look at the details. And they had revenue of $9.44 billion, I've got right here, versus 9.35, up 8% from last year. That's just pretty average, especially what expectations should be. Their guidance was a little below expectations. David, there's only one thing that everyone was keying in on, Wall Street. Almost every single Wall Street note had Salesforce revealed that they got 200 agent force deals in its first week. Now, they are putting a tremendous amount of sales effort behind agent force, which ironically, they're scaling up a lot of employees to sell, AI here. But they want this to work. And the mere mention of that kind of momentum behind it was enough to basically re-rate the stock trajectory where it would normally be down after these earnings. So, there's the Salesforce side. I'm not going to recommend Salesforce today. I won't say it's a bad company for any. It's very large, and we might try and go down for a little bit more, smaller opportunities kind of in the software space that have more to gain. But what it shows is, if we've talked about 2025, one of the biggest key themes being the kind of era of agents beginning. And this just kicks it off with a bang. We're about to start 2025, and we see the first company really being able to show sales momentum behind it, gets this kind of boost from Wall Street the next day. I think companies are able to show sales momentum behind agents are going to become many of the darlings and many of the top performers across the software sector this year. So, we've talked about this being the case, that we believe this will be, and now we have an objective reality to point to. And as I said last week, I think it's time to go hunting for, the next companies that are going to have, AI narrative and software. And, we'll get started right now.
Yeah. And I mean, I think another one that's kind of always on my radar, and that's similar, ServiceNow, a company, again, a large enterprise client base, it's had an even better year than Salesforce. I think it's up over 60% this year. So these companies that have their tentacles in existing enterprises, they have the ability to introduce new applications, use their Salesforce, not the company, use their Salesforce to go sell new software. So yes, certainly a lot of that seems to be another wave on the horizon, from the build out to the software, as we talked about, as many waves on the horizon.
And ServiceNow, I believe it was 6% the day after Salesforce's earnings. So there was ripple effects of everyone looking for the next most obvious candidate. So you nailed it with that one.
Yeah. So let's move on to, again, so a couple companies in the portfolio that have maybe had a few dips that you think might be worth adding to right now.
Yeah. The companies I want to buy today, we've bought $10,000 worth of Synopsys before. We will be adding another $10,000. That is ticker SNPS. And then we will also be adding Cadence, which is, I believe it's CDNS. You can correct me if I'm wrong in that, David. But the big picture here, and I've talked about, if you go back and you listen to either the first or the second podcast, we talked a lot about Synopsys as the idea of a company that could be a core holding, because they design the software that's used to make semiconductors, what we call electronic design automation. So it's a good business because you're riding the trend of growth in semiconductors and growth in AI, right? That's not hard to grasp. But what might be discounted a little bit is the narrative these companies are going to have from their artificial intelligence initiatives in the next year. I'll go to a quote here. This is from Cadence's last earnings call. Our Cadence.ai portfolio, powered by Gen AI agents, AI-driven optimization, and big data analytics Jet AI platform, saw sales nearly triple over last year as it continued delivering unparalleled quality of results and productivity benefits. So, David, all of the company's top customers are using AI solutions, and that's going to be true of Synopsys as well. Generally 5 to 20% improvement in the actual chip design. So that's power, performance, and area. So the actual products are getting better. But we're also seeing productivity growth that they claim at 5 to 10 fold. One of the key areas, whether or not that number is directly accurate, exaggerated, what you want to call it, one of the biggest areas that we're seeing productivity growth in from AI is with developers who have really learned how to harness AI, because again, you've got tech-centric people who are able to get the most out of it. So I think when you're looking at chip design, you're going to see, again, another area where people gravitate towards AI solutions very quickly. Now, these two companies, they are kind of a Pepsi and Coke situation. Between them, I believe their market shares somewhere in the 70 to 80% range. But we have an emerging opportunity that Synopsys was down 11% on Thursday after reporting earnings. I said when we first talked about them, this is a great, put it, in a glass case, breaking case of emergency. I'm getting all my old things back. I got F1, I got that. But so we're doing that right now, because when I look ahead why they're down, it was because they did conservative guidance for next year, but they had pretty good explanations for it. Conservatism related to China, which we've seen tearing the semiconductor equipment space apart. A reason I haven't recommended that yet. They had some issues around the next fiscal year having less week. And most importantly, their bookings backlog looked tremendous. It was up 21% and growing in excess of revenue. So the fact is, David, we started this episode off talking about how a company like Marvell is doing great because of their custom design business. There's a lot of custom work happening across all the companies serving these big hyperscalers. All this custom work is only leading to more revenue from these EDA companies, Cadence and Synopsys. We're not going to suddenly start graduating 3 times as many people who are experts in creating chips to fill all this AI demand. We're going to need better software that utilizes AI. So, David, I just love that. Yes, these are companies that are levered to semiconductors, which we have a lot of, but they're also software plays that have a very strong narrative around how AI is going to fuel growth in the years ahead. So we're taking advantage of an opportunity, a little post-earnings sell-off, and we're going to be adding them as well. So we've got Broadcom, $20,000, second buy, Synopsys, another $10,000, and adding Cadence with a $10,000 buy. I don't know if you've got any other questions, but I feel really good about these companies, again, forming kind of a bedrock for portfolios to go along with, maybe some of the higher risk stuff that we'll continue looking for in the weeks ahead.
Great. So adding to those, Marvell, Credo, companies that, again, amazing couple of weeks. You still feel okay about those? We're holding on to them. Obviously, results have gone up, valuation's gone up, but enthusiasm and operation results have gone up. So is there anything, I guess to jump a question on you, is there anything in the portfolio? Is there something under the surface that is giving you new worry? Again, we talked about scaling laws last week as this kind of boogeyman that's out there. We don't know when it might ever emerge or how that might come across. Is there anything else that you're watching of kind of like, it's a little bit of a concern on the horizon? Again, I want to try to temper our enthusiasm. It's great when our portfolio goes up 50% in a day, but is there anything else you're worried about right now?
I mean, valuation keeps me up at night. One of the companies I've talked about on this podcast was Applied Optoelectronics. It was a company I was adding across the summer. I love the potential for it to get, they were talking about a lot of new potential customers. They were talking about a lot of scale. It just was unclear on timing. I talked about them in a podcast, I believe in early September, saying, I'm just concerned about valuation. They're at $15. They're at $40 today. They're down 20% yesterday. They're up 18% today. There's definitely some froth. There's companies. Do I wish that we had bought more of Credo in the portfolio? Of course, it's up a lot. But as much as is re-rating and you're seeing all these incremental sales, to your point, it is concerning when a company jumps that much. You love it, but you are wondering, does the incremental growth that they're now showing, does this inflection point, does it justify where the stock is going? I've talked in the past about Astera Labs. It's a company that I think is really levered strongly to where growth is. And, it is just making a call on whether or not, you feel comfortable with that valuation. In a way, David, what would be my number one thing that I would like to see right now? Well, everyone on the podcast is going to hate me to say this. I would love to see the market sell off. I'd love to see it because I'm not invested for, 6 months. I'm invested for the next decade, right? And if I could get a big sell off that washed out a lot of people going into these names for momentum, and I was able to scoop up all the companies I thought had the best growth prospects for the next several years, I would welcome that. It would be incredibly uncomfortable. As you're talking to me in a podcast after it happened, I would surely be a little bit more afraid, but that would be the best thing, that if you truly believe in the trajectory of this trend, that would be the best thing that could happen at a moment like this. So, again, if we saw a sell-off where suddenly the market retrenched 10%, I definitely have a lot of names that I've been struggling with whether or not we should add them right now, that maybe that would give us the opportunity to ask. And maybe a stock like Credo, that if the market was down 10%, might be down 30 or 40. And if you're already up 170, you're still going to be net up quite a bit from that. But that's kind of the profile of these momentum stocks right now. So as we've talked about in the past, I think the stocks that we're buying have clear inflection points in revenue. Almost all of them are profitable or near profitable. But in the market right now, you are also seeing, what are generally the top performing stocks right now? They're former SPACs. So, it does feel like if you asked me where the market feels right now on a greed level, I would say 8.5 or 9 out of 10. So yes, that's what concerns me. And, I just bring this up to say, the natural thing is if the market takes a dip, it's hard to have these holdings, but in a way, if you are committed to this, idea long-term and believe in it, that would be the most advantageous thing that we could see in our position.
Well, market froth at a 8.5 or 9. At the same time that we have a Hawk to a meme coin. I thought that would push.
Yeah, but that was down 90%. We should have
down.
started rating some crazy stuff again today.
Yeah, we can bring that back as a regular segment. But no, good reminder that, again, it's been a great run. We don't want to rain on the parade too much, but it's not always going to be this easy of buying companies. They go up. The market can change. The narratives around these companies can change in terms of how much investment's going into this space. So we want to take that long-term view. It's not always going to be this easy. We just want to reinforce that. So I think we're going to leave it there. If you have any questions, you can email questions@247wallstreet.com. We'd love to answer them on the show here. Please leave us a rating on Spotify or Apple. It takes 2 seconds. Just say, hey, thanks for Credo. Really appreciate it. If you hadn't bought Credo, hopefully this episode is helpful to give you a couple stocks that you can feel great adding today. So for Eric Bleeker, I'm David Hanson. We'll see you all in 2 weeks. People on the show may have interest in the stocks they talk about. This is not investment advice, so don't buy or sell based solely on what you hear.